300 billion in 90 days. Is AI the biggest bubble in history? $300 billion. That's how much money investors poured into startups in the first 3 months of 2026. Not in a year, in a single quarter. That's more than triple what was invested at the peak of the dot-com bubble in the year 2000. And 80% of it, $242 billion, went to just one sector: artificial intelligence. We are living through the largest concentration of capital into a single technology in human history. And nobody seems to be asking the obvious question: what if it's too much? This is the story of how $300 billion flooded into AI in 90 days. Who's getting rich, who's getting fired, and whether we're watching the birth of a new economy or the inflation of the biggest bubble the world has ever seen. Let's start with the numbers, because they're staggering. In the first quarter of 2026, global venture capital hit $300 billion across 6,000 startups. To put that in context, that single quarter represents 70% of all venture capital invested in the entire year of 2025. And it gets more concentrated. 4 deals accounted for 65% of all the money. OpenAI raised $122 billion. Anthropic raised $30 billion. Elon Musk's xAI raised $20 billion. And Waymo, the self-driving company, raised $16 billion. That's $188 billion going to just 4 companies in 1 quarter. Now let's zoom into the biggest name on that list: OpenAI. After closing its $122 billion round, OpenAI is now valued at $852 billion. That makes it the most valuable private company in history. And on the surface, it looks justified. OpenAI is generating $2 billion in revenue every single month. It has nearly 1 billion weekly active users. ChatGPT has become as essential to daily life as Google search was a decade ago. But here's where the story gets complicated. Because revenue is not profit. And OpenAI is not profitable. Not even close. OpenAI is projected to lose $14 billion in 2026. $14 billion. Its spending projections are staggering. $17 billion this year, $35 billion in 2027, $45 billion in 2028. Annual cash burn is expected to reach $57 billion by 2027. And the company doesn't expect to break even until 2030, at the earliest. So let's do the math. $852 billion valuation. $24 billion in annualized revenue. That's a 35 times revenue multiple for a company burning cash faster than almost any enterprise in history. For comparison, Apple trades at roughly 8 times revenue. Microsoft at 13 times. Even at the peak of the dot-com bubble, the average tech company was valued at around 15 to 20 times revenue. Now, defenders will say, and they're not wrong, that this isn't the dot-com bubble. During the dot-com era, only 14% of internet startups were making any money at all. Most had no product, no users, and no path to revenue. They were selling dreams. Today's AI companies are selling tools that hundreds of millions of people use every day. The revenue is real. The adoption is real. But here's what the defenders don't want to talk about. Where is all this money actually going? It's going into chips, into data centers, into electricity, into the raw physical infrastructure of artificial intelligence. And that infrastructure is breathtakingly expensive. OpenAI, Google, Microsoft, Amazon, and Meta are collectively spending over $100 billion a year building AI data centers. NVIDIA can barely manufacture GPUs fast enough to meet demand. Power companies are scrambling to build new capacity. This is the paradox at the heart of the AI boom. The technology works. The products are real. The demand is genuine. But the so-called AI companies are not making any profits. They're running on a treadmill that gets faster every quarter. And this brings us to the human cost. Because while billions are flowing into AI, the people who built these companies are being shown the door. On March 31st, 2026, Oracle employees across multiple countries woke up to termination emails at 6 a.m. No warning, no meeting with HR, just an email. Estimates suggest Oracle is cutting between 20,000 and 30,000 workers, roughly 18% of its entire global workforce. The reason? Oracle has committed $156 billion to AI infrastructure, and its balance sheet can't sustain both the workforce and the data centers. So the workforce goes. The cruel irony is that Oracle is doing well. Its net income jumped 95% last quarter to $6.1 billion. Its performance obligations are up 433%. The business is booming. But the profits aren't going to the people who built the business. They're going into servers. And Oracle isn't alone. U.S. tech companies announced 33,000 job cuts in just January and February of 2026, a 51% increase over the same period last year. Meta, Microsoft, Google, they're all trimming headcount while pouring billions into AI infrastructure. This is the pattern that should concern every investor, every worker, and every policymaker watching. The money is flowing up into a handful of companies, a handful of chips, a handful of data centers. And it's flowing out from workers, from smaller companies, from the broader economy. Now, is this a bubble? Let's be precise about what that word means. A bubble isn't just high prices. It's a disconnect between price and underlying value, sustained by belief rather than fundamentals. And there are warning signs. The valuations are historic. A 35 times revenue multiple for an unprofitable company isn't investing. It's faith. And faith has a way of evaporating quickly when quarterly numbers disappoint. But here's the other side. And this is important because intellectual honesty matters. The dot-com bubble comparison has a fatal flaw. In 2000, the internet was a promise. In 2026, artificial intelligence is a product. Hundreds of millions of people use AI tools every day. Businesses are integrating AI into their operations. Hospitals are using it for diagnostics. Law firms are using it for research. Software developers are using it to write code. The productivity gains are measurable and real. The question isn't whether AI is valuable. It clearly is. The question is whether the current level of investment is proportional to the value being created. And the honest answer is, we don't know yet. Nobody does. Anyone who tells you with certainty that this is or isn't a bubble is selling you something. 3 things to watch in the coming months. First, OpenAI's path to profitability. If the losses keep mounting and the revenue growth slows, the 35 times multiple becomes indefensible. Watch the quarterly revenue numbers like a hawk. Second, the infrastructure spending cycle. If companies start pulling back on data center buildouts, even slightly, it signals that the demand isn't matching the hype. NVIDIA's earnings reports will be the canary in the coal mine. And third, the talent market. When the best engineers start leaving AI companies for smaller startups or established firms, it's a sign that the insiders see cracks that the investors don't. History doesn't repeat, but it does rhyme. And right now, the rhythm sounds an awful lot like 1999, just with better fundamentals and bigger numbers. If this video made you think differently about where the world is heading, subscribe to The Money Plot. Hit subscribe, and I'll see you in the next one.